Good afternoon, everybody. Welcome to the first of Dunstan Thomas's series of webinars. I haven't got to do much today, apart from do some brief introductions. Having said that, in true 2021 fashion, the Amazon delivery guy arrived about 30 seconds before go live. The dogs all started barking, chaos, and it just seems to be a really good metaphor for the year. Been a year of surprises, I guess. Just, I had a little think earlier on, what have I been surprised by this year? I've been surprised by the fact that I trust my partner enough to give me a haircut. That's been quite a big surprise. I'm surprised it's possible to binge watch even more box sets than normal. And not having a holiday booked is a pretty big surprise for this year. I'm sure we're all in the same boat there. I'm also surprised that top dressing has taken on a whole new meaning and doesn't involve your lawn anymore. So I'm going to encourage our speakers not to stand up just in case. I'm also been surprised by how many times you can say you're on mute during a working week. And I think it should be the next pound box kind of swear word equivalent. You're on mute. And I've also been surprised how entertaining parish council meetings can be. So we're hoping not to have anything too controversial in today's session that will end up going viral, but very confident that it's going to be a really worthwhile session. I guess no surprise really that automated advice is taking on a much higher profile, particularly in a year where we've experienced the kind of things that we have done. So we thought it was an opportune time to talk more about automated advice. We're really happy to have Pete with us. Pete has got a long track record of dealing in the advice and automated advice space. I'll let him introduce himself fully as part of the intro to his session. Wealth Withers will be a familiar brand to all of you on the call, and I'm sure Pete's wealth of knowledge will be interesting to everybody. And Adrian, I'll introduce just before his session. So without further ado, I'm going to hand over to Pete for his session.
Thanks, Andrew. Thank you for that. Afternoon, all. Yeah, I think my introduction, we were just chatting before we came on, is I've been hanging around quite a long time in the advisory and automation space. It's an industry we all stay in too long. And if you were looking around you and you could see everyone in the room, you'll see some of the names on the chat. You are a seasoned group of industry professionals who definitely know how all of this works very well. So I will do my utmost this afternoon to avoid the bleeding obvious. That said, we should make no apology about it. We know the challenges well. We've been, as a group of individuals, probably trying to tackle them for a long time. And really, my own views on automation and the ways it's changing is just a reflection of the time I've spent working with many of you actually on this call in the last few years to try and help solve them. So as we learn and evolve, thank you all for joining. I'm going to do about 10 or 15 minutes just on some things that we see quite frequently. I think the first of those to bring out at the beginning, and we're going to try and talk about it, is the misconception of automation. So the whole process starts and finishes probably with what the customer wants. How do we drive the business, and what impact does it have on our businesses, and if what the customer wants changes. But there is quite a misconception of what automation means and the term robo. So we'll look at that. Most of these robo sessions start with the concept of the future and what's coming, but today I'm only going to talk about technology and ideas which are here, live, and in the market today, and that people are already using. So if I talk about something that's outside of that, I'll flag it, but everything else is live and working. I think probably the third bit that's worth just flagging before we go in is this concept that we've seen again and again, and I know some of you have presented on this subject, is adapt or die. And I am not a massive believer actually that it is adapt or die. I think actually what we're seeing in this market is a huge opportunity to expand the market and to do more with more people. And those that are are advising and engaging in a more traditional way, there's a huge demand. And I think that demand will continue. So I'm seeing it as an opportunity. I'm seeing it as a growth. Yes, adapting brings some benefits, but there's no need for everybody to do it. There is a huge demand out there for what goes on today. So if those are the three things, the misconception, the future, and adapt or die, then it's worth also tackling the concept of advice. Why advice? You know, we have lines in the industry. We know what advice means, and we know what it means to the regulator. But actually, what does it mean to the end user? So I think it's not just about advice. It's guidance. It's help. It's that whole plethora of what the client wants. But why is advice important? I think if you look at people on the very right-hand side of the spectrum, they really need advice. They absolutely can't act without it. They don't know enough and they need that help. And people on the other side, self-serve with abundance, probably all of you, you know how to do it. You're perfectly competent and capable. You just want to get to a solution. So you're self-serve. There's a mass group in the middle who could use either way. And what we're finding is that group actually are quite like the concept of the way advice works, because advice is really simple. It's like going to your GP. You go and talk about yourself for a bit, and people are generally quite good at talking about themselves. They know the answers, they know how it works, and they chat and they get asked about themselves, and it feels good. They talk about themselves, and at the end of the process, assuming it's worked well, somebody said, "Well, this is the answer." And then the other alternative to that is that people throw information at you, and here's some more, and here's some more, and here's more information, and did you know this, and here's a tool and a calculator. By the way, what is it you want to do again? And those two are starting to round in. That central ground is going up. It's quite comforting for me if you can help me, actually, and advice in a regulated environment. So all of that will come into these 5 or 6 slides, but it's quite key that we get that misconception. So let's look at misconceptions for a minute. Great labels of our industry that mean different things to different people. Good governance. I don't think anybody in this business advertises bad governance or bad compliance. So everyone seems to think they must be doing a good job. And then when you get under the skin, good governance looks very different depending on which organization you're in. So we have a badge. It should mean the same to everybody, but actually everybody does it slightly differently. I think if you ask 10 people what a platform was, you'd certainly get 9 different answers. What's a platform, including the one it's a train where a train stops. Everyone seems to have a different view of what a platform is. If I go into people we work with and said, "What is your understanding of automation and robo?" most people have put it in a box. They put it in a box to suit them in their own environment, what they understand by it. And I think possibly, if it feels really illogical, if you think, "Well, robo doesn't work. Why would you do that? Surely people want this." If it doesn't work for you, then maybe your understanding is different to those that are very equivocal. For me, the thing of robo is very straightforward. It's completely independent of the way in which we interact with the end user. So the automation of our industry in the back office shouldn't be linked to the need for the end user to interact with their mobile phone. And it's the biggest challenge we meet. People think robo advice, automation means I'm playing on my phone or I'm going through my computer. And I don't think that's the case. So some of the most successful things are empowering advisors to deliver a better system. And all of it should come from one place. So if that helps, feel free to throw questions into the session and we'll pick them up at the end. But the concept that automation means you go through your laptop shouldn't actually be the way we want to play. And just to make that apparent, we've got some ideas up on the screen here. As of this morning, there's a little ticker tape runs. If anybody's ever looked at it, there are 68.1 million people in this country. I don't know how it counts them on a daily basis, but it does. And we look at those and say, well, about 33 million of those are employed, about 35 million of them bank digitally, and depends how you count them. There's lots of ways, but let's assume 34 million of those have a pension. So give or take half the UK population by each of those remits, maybe a target wealth audience somewhere in that bracket. about half the people could come and use the things. And I know you all have different businesses and different drivers, but half the UK could interact with an automated wealth system. So if the solution is to automate the process so it gets done at the right cost and the average consumer can afford it, that brings us back to this. If the right interaction is a true face-to-face, paper-driven, historic process, then keep doing that. Keep doing that. We absolutely don't want to automate here. But what we've got on the screen is this concept that about 5 million people regularly want to interact and take financial advice. So how can we make that better, more efficient, more engaging? How do we improve that? And then there's the other 30 million or so that don't regularly come and take financial advice, but maybe could. And if we could turn that into a system and process and make it work well for those people and at a cost base that suits everybody else, those are the two sort of targets that we would break the half the population into. And of course, there are benefits to various people depending on where you sit in that value chain along the 35 million. We had a mission really in this process as well, so just bringing it back to ourselves for a minute, to make this financial advice affordable and accessible to everybody. What you'll see there is we think that it is two different channels in that process, but absolutely one platform. So if you interact with anybody at any point who does financial advice, the facts that you give should be entered onto a single system, and that system should be able to play back to you digitally or through a human being. You should never run two systems, separate the two. And what does that mean to the end user? Instant feedback, more engaging process. We start to see this choice coming in as quite an important consumer factor, really. And so we start asking ourselves, what is it that the consumer wants? And what are the benefits to us as an industry of supplying it for them? I don't know about all of you, but the concept of, oh, your mobile phone's a big part of your life is about 10 years, 15 years old now. And people are like, we know that. But I do think expectations might have changed. You know, if I buy food, get my news, organize my banking, or even go and see the weather, it's become more instant, certainly more accurate, very, very safe place to go. I feel it works and it's trusted. It's useful, it's engaging. So consumer expectation right across the generations is, you know, I want it all. I want it all and I want it now. Right back to the songs. And I think that reality is not always delivered in wealth. Banking as a benchmark, who knew that banking would lead the way? But when I go to my bank, I expect just minimal things. I can transact, I can find all the information. It's online, it's 3 presses of my mobile phone. It's not going to break or let somebody else in. I just don't need a bank manager, as they did 40 years ago. That world has entirely changed, and wealth hasn't quite kept up. And under the skin, we think it's probably risk managed, the regulatory, the transactional, the value, the risk of doing it. There's a regulator with a view in the middle, and so we end up with this concept of people go, you know what, I'm not going to give advice. I'll stay away from it. It's too risky, and I'll put a load of barriers in the way of the consumer, and they can work it out for themselves just to prove that I didn't give advice. Or I will give advice, but it is expensive, and therefore I can't serve the whole market, and I'll go down. So either not doing it at all or doing it in an expensive way. And we believe that automation's put that middle ground in. You absolutely can deliver advice in a cost-effective way to a low-value client or account at a time and place to suit them. So another big development that just wasn't available this time. So as we went through that process, we started to form these beliefs. We're helping people to fill that middle ground, to deliver pieces of technology that run this game. We've moved away from robo is digital. It's how to help the consumer in a way that the consumer chooses to come and interact with your business. And we launched this first fully digital regulated advisor. So this is a chatbot. It was quite a thing to do. It has no human interaction. You can refer out, you can come out of the system, but it's a chatbot. It's fully regulated. It delivers advice as a personal recommendation at the end of the process. It's got an element of AI in there, but it's also got a lot of, actually, this isn't that complicated. And it proves hugely engaging. And as a backup, supports wingman, if you like, to the advisor industry to do the things that the advice industry wasn't keen to do. Lower value, some servicing tools, sort my ISA out, top my company pension up. It's absolutely phenomenal that this thing can run and work and deliver in a regulated environment. So this is no longer a concept or a theory, it's absolutely real. The question is, where does it fit in your business plan? How does it help you run? And the reason that we did it, so we're a B2B business, we supply the industry with technology to help them do their own work. The reason that we went live with our own regulated advisory is because nobody believed it could be done. So it's broken a bit of ground, it absolutely works. And the nuance here, I would say, is that the UK industry is tough. We expect our wealth managers and advisors to be hugely skilled. They have to be salespeople. They also have to be human engagement specialists. They've got to know how to run their own business, manage regulation. You know, this machine cannot do all of those things. But as part of that environment, can it pick up some of the slack and deliver the customer what they want? Absolutely. So the machine's job is to sort everything else so the advisor can just get more face time. And I think even we've been surprised by the traction and what can be done and the degree to which the end user thinks it's a really helpful thing. Oh, sorry, clipped past the fact that what we're not in here is an investment manager or an investment platform. And the reason I think that's important is you see robos packaged, where actually it's just a tool to deliver somebody's funds, which is absolutely fine. But we're not either of those. It's IFA, it's ambivalent to, and it can be plugged into everybody else's system, which is why it's there. A couple of other quick notes. We see that COVID's accelerated things. There's lots of news coming out. It will all bed down over the coming years as to just how far and how fast it went. But if you're running a team of a couple of hundred advisors in your business and you wanted them on the road and they're not on the road, you needed to adopt tech pretty quickly. So we've seen some adoption where there might have been a desire to go more slowly. And I think for those who were already digitally enabled, it's just confirmed that actually it was a direction of travel. So we'll see the ultimate impact of that. The concept of video calls, online portals, and efficiency tools will be familiar to you all. You all understand the parts that plays, you know, data feeds running into a system that the client can access. The thing I would talk about here is joining them together in such a way that the consumer feels, actually, I want it all and I want it now. They feel that you've really, really thought this through for their best interest. They can find, if they put a piece of data into your system in one place, it absolutely finds its way to their fact find. You knew it next time you spoke to them. And that logic is simple and understood by us all, but rarely is it working as effectively as it should in the industry. So I think if you think about the banking, we come up to the expectation, the move in digital adoption. It's all driving us into, well, what are the questions your customers are asking? What's coming through the front door? And we get a massive mixture. The people who are just curious, want a bit of information. The people who really brutally need the advice, and those that really can self-serve, as we talked about earlier. And so there we put those forward into triage, advisor-led, and self-serve. And really we're helping people to find out which of those they want. Very aware that the person who wants to invest and self-serve into an ISA today may well want to be advisor-led tomorrow when they retire. So it's not a one or the other. You should be able to hop between all three of these at will, even halfway through a journey, and back again, should you want to complete. So that's where the tech fills the gap. I'm not going to dwell on these, the gamification, the stuff you will understand, how each one works best. But the concept that we're building a single fact find, the concept that the system is spotting inconsistencies. Over here you said this, over here you've said that. Why? We've got a difference, and the AI within it should be absolutely flagging the outliers. It should say this person's come all the way through this process and they've said this and that and the other, and we think it's okay to do this, but they're an outlier. This is an odd case. And that's what brings you to compliance, and the fact that we can spot an inconsistency before that results in an outcome. So the system is live. It should be popping up to the advisor going, this all seems fine to you, but we've got a red flag, you need to pick it up. And it gets caught before the advice happens, and therefore the problem is removed before it starts. So we get into practical implications. About a minute or two to go, so I'll zoom through this. But the reality of this is, we started here with a 13-hour advice process for somebody, with about 2 hours of the 13 hours client facing. So enough. Trying to get through the process. Client was happy with a couple of hours, but there was an awful lot of back and forth and checking and compliance. We put the technology in, and we're under 5 hours. So we've taken a fair chunk out of the back office, but we've still got 2 hours of client facing time. And the reason I use this as an example in an automation session is because advisors are our biggest challenge or advocate of the system. If you don't get it right for them, they'll tell you if you missed a comma on the end of a line, let alone whether the advice was right. And what you're seeing here is, when we set off, about a third of advice cases were fine, 2/3 needed a bit of tweaking by the professional advisor. We're now running about 86% of all cases are just the advisor looks at it before the client sees it and said, that's fine, sends it out the door. And we go up to 93 when you realize that all they're doing is adding a name or a tweak or a little something that they thought, we try and get all the personal touches are in there, but they just wanted to add a little something else, but they still went with the automated outcome. So we've got a very small percentage that says the system goes, that's too complicated. Somebody else needs to have a look at this. There's something in here that I can't do. And hence the efficiency gains. So I think if I was going to summarize 3 or 4 key points, it's about providing choice. Let the consumer decide. Let them hop between systems. Let the consumer come and play with you the way they want to. That's where your digital engagement comes from, because they're getting what they want. I want it now, and they're getting it. Staying ahead of client expectations, the expectations we build up when we work with our bank. That enablement of self-service is huge, because today, everyone on this call could probably self-serve most of the things they need, but they might just want that check-in, and allowing them to do that and jump across a time and cost to suit them. The reg tech then comes in. We are delivering incredibly robust compliance here, 100% audit trails, complete data dive on the MI. You can see everything that's gone on every time they've touched the system. You can manage the outputs, not let things out the door. So the MI piece we could spend an entire session on, but ultimately you reduce cost to serve. And then you decide who gets the margin. So my view on automation is it's moved on a lot. It's now half in the background, half in the foreground. And I hope some of that was useful. Andrew, back to you.
Thank you, Pete. Really good, really insightful. Appreciate you coming to speak. We're going to save all the questions to the end. So I'm going to mute you and just drop your video off until we get to the end. I'm going to introduce Adrian. Adrian's got several hats, as most of you are probably aware. Today's hat is as Dunstan Thomas's retirement strategy director. So Adrian speaks at a lot of different events in the industry. Very well connected. Has got his finger on the pulse in terms of what's going on from a regulation and government perspective, and is always a really interesting speaker. So Adrian, I'm going to hand straight over to you. Hopefully you can share your slides.
Thank you, Andrew. Yep, I'm hoping that you're all hearing me loud and clear, and I am going to screen share. I have a PowerPoint deck to share with you. Brilliant. Lovely. Away. So thank you very much all for coming. I'm going to follow on from where Peter got us to. Obviously, unlike Pete on talking investment pathways, so I'm not delivering advice online here in the regulatory sense. But I think there are quite a lot of similarities with the mechanics of what Pete was talking about, because we are delivering a self-service approach that will take people through to the point that ends with an investment allocation. We are now, let's think, 18 days into investment pathways. Those of you that have got non-advised customers will have set up your investment pathways from 1st of February this year. Of course, they were, as you will be aware, created because many people entered income drawdown solely to get their tax-free cash, having very little regard for the other 75% of the pot that they left invested. The aim, of course, is to ensure that those entering drawdown without advice only invest in cash or mainly in cash if they have taken an active decision to do so. Cash, as you'll be aware, earns very low returns at the moment. The top pick on this week's Savers Friends email, if you get that from Moneyfacts, is a really useful email. The new Paragon Bank Triple Access ISA pays you 0.4% per annum. And that is a pretty top pick. I don't think I've got any money that's earning that much at the moment. I had a quick look at the 3 SIP plans that I've got my own funds invested in. They do pay, interest on cash. 2 of them are at 0. One of them pays a weeny bit, but it's less than the 0.4%. And indeed, cash may soon pay negative rates, actually. It may actually go down. A bit of a frightening thought, but the Bank of England have now asked banks and building societies to prepare their systems in case the bank decides that they need to go negative and we move into negative interest rates later in the year. So we're doing this because we think customers will enjoy a better retirement by doing so. We believe there are better investments than putting everything in cash, and that these investments can be tailored to customers' own risk tolerance and their future plans. We believe that is not a guarantee. Of course, their money may go down if it's not in cash, but we believe this, and the regulator very strongly believes this, and we're doing investment pathways, as you all know, under a regime where FCA have mandated it. The particular thing that FCA wanted to stop was this sort of message that you see in red on this slide. This was a common message that a lot of income drawdown providers would give to people that had come onto their platform to draw off that 25% tax-free cash, the bit they're interested in. And they'd say, you can choose your drawdown funds now, or you can just select cash and return later at your convenience and tell us how you'd like to invest your money. Later, of course, was often not later in the same day or week or month or year even, and people would sit in cash for a very long period of time. So that's not going to happen now. We have instead a window of opportunity to deal with clients. They want their tax-free cash. They've come onto the platform to get hold of that lovely 25% tax-free cash. Maybe they want to buy a car or a conservatory, a holiday, settle their mortgage, pay off some debts. They want money. They want money now. We've got their money. We can give them their money. However, we're going to make them work for it a little bit before they get their money. So unusually for pensions, we've got the customer's full attention for a moment, because they want something, they know we've got it, but they're going to have to work a little bit in order to get it. Kind of to help you understand why I'm so excited about the fact that we've got the customer's full attention for just a moment in time, I look at data like annual benefit statements. Less than 1 in 10 customers open an annual benefit statement. That's how little attention they're paying to most of the stuff that we're sending them. We've got a moment with the customer here. Just imagine that you've got in a lift tomorrow with 2 people. You can only get 2 people on a lift today at the moment because of the social distancing. And it was you and Joe Biden. What would you say to change the world for the better? Are you ready to grab that little window of opportunity that you've got with somebody to talk to them? Hopefully, we have it here with investment pathways, and we are talking to people that are normally incredibly unengaged, and this is exactly what the FCA have reminded us. This quote from PS 1921 is reminding us we're dealing with desperately unengaged customers. But I have to temper my offer a little bit, because actually what we're offering them is rather weak. Yes, we're going to give them their tax-free cash, and that's the bit they want. But on the other 75%, what am I offering them? I'm saying engage with me, look at the pathways, choose the one that's right with me. I'm actually offering them deferred gratification. I'm saying you're going to get a better retirement later on down the road when the investment's done its work. Well, people aren't terribly excited about the stuff coming later on down the road. So although I've got their attention, I do think we need to keep it quite quick, keep it quite easy, give them some reassurance when we get to the end of the process. And Pete was saying that reassurance is very, very important, particularly where people have been through a sort of techno process and haven't spoken face-to-face with people. Maybe you offer them a little counter, like I popped on the bottom here. You're just 5 screens away, folks, from receiving your tax-free cash. So hang on with me. We haven't got too long to go. Now, what we say to them, of course, is we say to them, thinking about your life ahead over the next 5 years, which of these 4 is the ones that you recognize? You on the line, of course, will recognize these words because they're exactly mandated by FCA. So I won't waste your time by reading them out to you. But those are the 4 choices that we will put down in front of them. FCA did a reasonable amount of sort of customer checking to see that they were understandable. However, I think it'd be a great idea if, when you offer those to people, you actually give them the chance to sort of, expand them a bit in case they don't quite fully understand what they're meaning. So offer them the opportunity. Say, hover your mouse over, one of the sets of words, and it will give you greater explanation. If you hovered your mouse over the first one, I have no plans to touch my money in the next 5 years, you might offer them these additional explanations to help them to understand that that really is the sort of person that they are. And I say to them, you've got a salary or some other source of income that's going to meet all of your bills for the next 5 years. The tax-free cash you're drawing off, so one-off purchase. You're not expected to come back and repeat that within the next 5 years. You're not expecting to dip into your pension pot for other major expenses, another new car, home refurbishment, holiday, etc. during the 5 years. You won't be using your pension pot to help out your kids or other relatives during the next 5 years. And the retirement that you're looking forward to spending your pension on is at least 5 years away from starting. So I'm asking them, do you recognize yourself here? Because if so, this is the one of the options that's for you. If not, then go back and have a wee look at the other options in order to see whether one of those is actually more appropriate for you. Now, I'm going to move on and look at some screens that we use at Dunstan Thomas for people that are finding their way through the investment pathways. And here you can see top left, we've put down the size of pot. This particular individual has got £100,000 in their pot after taking that all-important tax-free cash. So they must have started on £133,000 in order to do that. They've got 4 options with tick boxes, and they can tick the one that's applicable to them. And down in the bottom right-hand corner, you can just see in grayed out format the box for where are they going to go next. Now, this particular customer I'm looking at, he's chosen option 4. He said, I plan to take my money within the next 5 years. And he's used a little slider device in the second box down, slid that all the way up to £100,000. He wants to put all £100,000 into the investment pathway for option 4. So the little grey next box has now illuminated, and he could carry on from there. However, some people won't just, of course, choose one. So the software needs to allow for the fact that some people want to, split their things. This customer, the bulk of his money, £90,000, is not going to be taken for another 5 years yet. But he does think that he may well dip in and want another £10,000 out within the next 5 years. So he'll need to split his money between option 1 and option 4. And of course, we need to be able to allow for that. They could, of course, choose all 4 options. I suspect some will. Some years ago, I was involved in the direct marketing of a personal pension plan that offered exactly 4 investment choices, and a surprising number of customers chose 25% of their money to go into each of the 4 choices. I think they kind of thought they'd managed to cover all bets by doing that, although perhaps it wasn't a terribly logical thing for them to do. That customer had chosen 2. This customer has tried to choose 3 of the boxes, again, and possibly logical thing to do. And unfortunately, his mathematics is not terribly good. When he ran the sliders along to the right and put some of the money in each, he hasn't managed to spend all of his money yet. So the little grey next box is still greyed out again. He can't go on from here because there's £10,000 still not allocated. Let's assume that he tries a little bit harder, and here we go. We've now managed to get all the money allocated, so the little grey next box has arrived, and it is safe for the customer to move on. I want to take you on to where the customer is going to go to next, but to make that easier, I've gone back to a customer that's just in a sort of single box. So we're just looking at somebody who's chosen option 4 and has told me they plan to take their money out within the next 5 years. They've made an important decision, and it's quite critical, I think, at this time that we take a moment to help them understand that they have taken a momentous decision and that we've taken account of it. So we would want to play their answer back to them at this point and then tell them what's going to happen next. So we tell them, you told us I plan to take out all my money within the next 5 years. And we are therefore going to invest your money in a way that will meet this objective. Our investment manager will hold your money in cash or short-term cash deposits at banks or market securities. And this will meet your objective by ensuring that your money is not at risk of going down. We might have to reword this messaging if we do in fact end up with negative interest rates, but let's hope we don't get there. And then we could offer that customer the opportunity to say, would you like to go back and revisit your choice? If when he's heard us play back to him what he's gone for, he realizes that really wasn't what I wanted at all, or indeed the opportunity to go and look at other investment options, because there may well be some non-pathway options that are on the platform. The important thing is to encourage the customer to look at those pathway options first before they head off into the non-pathway options. And then we kind of say to them, well, is that your final answer? It's a bit like the moment where Chris Tarrant or Jeremy Clarkson on Who Wants to Be a Millionaire is saying to you, final answer? Yes. And hopefully they will say, yes, that's their final answer, and we can move on. Now, I'm a great believer of actually taking at this point a moment to test the consumer's understanding of what they've done. And that's because in many cases, customers do things without fully understanding. Some of the pension schemes I work with have actually calculated the average reading age of their membership and come back and tell me, well, it's age 9. And that sounds horrendously low. But in fact, if it's an employer where the workers are, sort of manual workers, they may be highly skilled, they may be highly professional at their job, but it doesn't involve a lot of reading, and they're not terribly good at reading and comprehension. So it may well be worth testing consumer understanding. We don't do testing terribly much in the pensions industry, and I'm sad about that. But there are other industries that do it. Peer-to-peer investing have got this really off to a fine tee. Reputable mini bonds often use multiple choice tests to confirm customers have understood what they're buying and are not confused by it. I say reputable because, as you know, there are many disreputable mini bonds as well, and FCA have had to take a lot of action against those. I suspect the disreputable ones prefer to keep under wraps how they're really working and what they're doing. But the reputable ones are keen to check that the consumer understands the risks that they're taking and the returns they're going to get and the lack of liquidity and so forth. If we introduce testing here on, investment pathways, well, it does a number of things. It will improve the robustness of our compliance when, FCA come visiting. It will also provide some valuable reassurance to the consumers that have passed the test to confirm to them that they understand that they've understood what it was they've gone down. And it can provide another valuable function in terms of alerting the customers that fail the test that actually they haven't understood the decision that they've made, and that actually the plans that they are trying to do are inconsistent with the investment allocation that we're giving them, and that therefore some further work is required. Just to dwell on the importance of that robustness of your compliance, I noticed that the Ombudsman now says that they are handling 4,000 SIP complaints per annum. 60% of the Ombudsman complaints are for poor provider due diligence. And 2/3 of these are coming from professional claims managers, people who know how to make a complaint and extract money from the institutions that they are complaining against. So if you've done some consumer testing, then I think that could be a really good idea. So I've got an example test here that we could deploy on the individual who had told us, I plan to take out all of my money within the next 5 years. We play that back to them and suggest they might like to select the statement out of this list that most closely matches their situation. And I offer them these 4. Once I retire, I'll need this pension plan to provide me an income for the rest of my life. I support my husband or wife or partner, and when they retire, they will also be relying on this pension plan to provide them an income too. I'm expecting my pension plan to provide some big expenditures over the next 5 years and to provide me with an income throughout my retirement. Or I have another source of retirement income that will meet all my bills when I retire. Hopefully, they're going to choose option 4, and that would be consistent with the statement that they plan to take out all their money within the next 5 years. If they're choosing options 1, 2, or 3, then that is revealing that they have not understood that what they've told us they're intending to do is inconsistent with what they're actually going to be doing. And that's the sort of thing which the testing can reveal. You might ask, a number of these multiple choice questions, perhaps up to sort of 5, 6, maybe as many as 7. And then, of course, we have to think about what happens when we score them up. You'll need to invent a pass score. I don't know, maybe 5 out of 7 might be the number that your compliance team would say had delivered a good understanding. If they've failed, then, of course, you'll need to think, well, what are we going to do now? You'll see these sort of quizzes on the internet, and BBC run a weekly news quiz. You can have a go on that, and depending on what score you've got, it sends you back a sort of slightly funny message. So if you scored 0 out of 7, you might get a message saying, well, you're a complete financial nincompoop, aren't you? And unfortunately, we can't just do that in our case, because we can't leave them at that point. We've actually got to do something and pick up the pieces of the ones that do fail. In a way there, we are different from, for example, the peer-to-peer or mini bonds that I showed you earlier on. Because if you apply for a peer-to-peer account, but you fail to understand how it works, they can simply tell you, you're not a suitable customer for us, and discard you. We, of course, we're looking after the customer's money already. So we can't look at discarding them. We've got to help them back through the process again. We could simply tell them to go around the process again and have another go. We could direct them to PensionWise. I've done a PensionWise appointment. They're really good. You get half an hour with an individual that thoroughly explains the various options that you've got at retirement. And they score much higher than that 0 out of 7 if they went to PensionWise first. We could provide them a help desk that they could ring up and get some useful sort of information from them. I would suggest we don't say, please go to unbiased.co.uk, because I kind of think they're unlikely to find an IFA that's going to want them. But we could direct them to another page on our site with much better explanations about the options that are available. Whatever help we've given them, we then need to send them back round the investment pathways process again. Having gone round again, I'm going to assume that they have passed at that point. Once they've passed the tests, they have reached the end of the process. We can give the tax-free cash across to them. That was the bit that they really, really wanted. And the consumer's remaining funds, the other 75%, are now invested in a manner which meets their financial plans and objectives, which was what the FCA, of course, wanted us to do. And they are only in cash if they've actually made an active choice to do so. I'm hoping that my pile of 50p coins, of course, has got one of those 2009 Kew Garden specials in it, because in which case it'll be worth rather more than the pile of coins in my illustration. Afterwards, we've completed. I always think, having done a process, you can actually go back and survey your customers and say, well, how was it for you? Particularly given that this is a new process, it's not been done before. So it's a really good idea to go back and work out whether it worked for them or whether there are things to change. We're probably only changing presentation rather than content of the material, because this is pretty prescriptive in terms of the FCA's rule book as to exactly what we have to say and what order we have to say it and present it in. But I think it's still useful to survey them and see whether there are things we can do better. We know also that the FCA will be surveying people. They'll probably be surveying other firms' customers rather than yours, simply because that's the way that surveys work. It's always more likely that somebody else's customers are going to get picked rather than yours. But if there are things that don't work so well for your customers, you'd actually like to know that and feed that into FCA with a hope of getting them onto the list of teething issues that the FCA will need to be resolving. Hopefully the feedback will be good. Hopefully, reflecting on it, people will feel that the experience was useful and helpful. And that's great, because what you've done there is you've reminded your customers that they've had a good experience with you. And that builds loyalty. It builds good Trustpilot reviews. It increases the likelihood that your customer is going to recommend you on to their friends. So reinforcing with the customer the fact that, yes, they've had a good experience with you is actually enormously beneficial for your business too. As you'll see, I flagged up, you are now just one screen away from the end of the presentation, and the end is going to be moving us into the any questions section. So I will pass back to Andrew, who will take control and compare questions. Thank you for listening.
Thank you, Adrian. Okay, so let's see if there you go. Driving's gone okay today. So we do have some questions. I've asked everybody to vote them up, so I'm going to do them, given that we are a little bit time constrained, I'll do them in vote order. So the question with the most votes came from Michael. And Michael asks, why have the first group of robo-advisors failed? And some examples there are Santander and Money Farm. Pete, want to pass to you in the first instance?
Yeah, that's fine. There's some great stories on robo-advisors starting and disappearing again, most of which are really quite worrying. I would point you to probably the master trust industry as the closest comparison. Was master trust a good idea or a bad idea when it started? We saw 106 register in the end. There are 38 left. There are growing pains. Every one of them told us they were going to have 20 billion in assets, because you needed 20 billion in assets to make it profitable and good fun. So they all set off with massive objectives, and they can't all win. So I think you will see robos come and go. You'll have to decide whether automation in this space is helpful, but I wouldn't put a lot of judgment in those who haven't made it or have been bought out. There are 3, to my knowledge, that vanished and actually are just incubating in other companies right now. So I think it's not a sign that it's not going to work. It's just takes time.
Great, thank you. Next question. The FCA does offer to regulate guidance. Is there any market for robo guidance? And if so, what value can regulation bring? And maybe actually part of what Adrian was talking to is some kind of crossover between what's that little bit beyond guidance that'll give that extra assurance.
Happy to go first on that one again.
Sure.
From our perspective, nearly all of our journeys start with robo guidance, if that's the term you want to bring to it. Virtually everybody who enters our system will start on their mobile phone. They'll start with a Q&A or a chat journey, and it's not regulated advice. It doesn't need to be. There are people who do the triage in different ways and bring people to a regulated journey right at the beginning, but for the vast majority, they're not sure what they want. And this line in the sand that we have as an industry means nothing to the average consumer. They just want help. And really, it's a duty of care I think we've got to decide when it should be regulated advice and when we should be helping them make the right decision rather than letting them get to an outcome where they buy something which may or may not be correct. So I don't have a view, non-reg outcomes are absolutely fine. Non-advised outcomes are a good thing. And guidance, automation is good. So it's all about the right thing at the right time for the right individual.
And I guess there's the across the board motivation, right? So we're all really interested. It doesn't matter whether we're the regulator, service providers, software providers, advice providers. Customer outcomes has to be at the heart of all this, and that is the kind of common parlance, really. Adrian, any kind of further comments on that?
Yeah, I think it's interesting. If you look at, two customers with the same outcome, so they've both bought the same product with the same investment allocations. One was advised, one was not advised. The critical difference in the process is the advised one was told by the advisor, this is my recommendation, and here's why. The non-advised one that went through a guidance process perhaps has reached that decision by themselves. And I think it comes back to that point that I mentioned earlier on, that Pete mentioned about reassurance. In the case of the advised one, the advisor delivers that reassurance, and it might be delivered at the point of recommendation. It might be delivered at the point that the advisor is leaving the client's house as that final handshake as they're going on. You're doing the right thing here, mate. I'm so pleased you decided to invest in a pension plan. The question is, can we find a non-human way to deliver that reassurance that is not advice, because we're talking about, guidance and non-advised. And you can use the technology, and it might be the testing, it might be the playing back to them. It might be, periodic updates with, how things are going and stuff. But that reassurance is a very human need. So the non-advised customers, they need it too. And we have to find a sort of technological way of delivering it to them where they haven't got that advisor eyeballing them, giving them that very personal reassurance.
Okay, thanks, Adrian. Chris asked the question, where does the percentage assets under administration sit between advised and non-advised? I'm not sure everyone's going to have that metric, maybe. And is there a change through lockdown? So, recent PR from AJ Bell and Hargreaves Lansdown, there's a view of destination over the next 5-10 years where there will be a significant shift. Is that something we agree with? Challenge?
Well, we know where the customer numbers sit, and the customer numbers sit 90-10, 90% non-advised, 10% advised. The assets, I'm sure, sit the other way around. I'm sure that more than half of the assets are unadvised. And that partly, I think, is a direct consequence of RDR and where it's taken advisors, because advisors are concentrating on clients that have money. Whereas if you went back 20 years ago, advisors were concentrating on clients that didn't have money yet, but wanted to start saving it up. It might not be as much as 90-10, but yes, there's a lot of the money is sat, on the advised platforms, but a lot of the customers are sat in non-advised space.
Yeah. And I think it's a strong move to solve that. I think automation gives the industry access to the lower value pots and the surety for both sides of a really rigorous audit trail on an advised basis, if required, to an outcome that was affordable. Because the reason those advice cases don't happen is because it just wasn't worth anybody's money to spend thousands of pounds getting that reassurance. So if the tech can lower the cost of that, the reassurance could be provided for 50 quid.
Yeah.
It brings so many more people into the realm where they can have that arm around their shoulder and said, this is the right outcome for you, at a price you can afford.
And I guess this whole thing is multi-dimensional as well, isn't it? So, what's the auto-enrollment overlay here? As time goes on, and more people save through their workplace schemes. How does that kind of transition into the requirement for advice and how it's delivered?
I'll happily take that one, because I work in the auto-enrollment space, with another hat on. And at the moment, we're very, very much at the beginning of that journey still. The auto-enrolled customers are, hugely disengaged. When we look at the split of them, we find sort of 99% of them are sat in default funds. But, as the amount of money that they've saved builds up, we hope they will become more engaged. as the proximity to retirement becomes greater, again, we have to become more engaged in terms of the quantity of money that they are putting in. And this is not an engagement that they're going to find a regulated advisor is particularly going to, help them with. So we need to use, the technology, the robo ideas, in order to start to begin and cultivate that engagement. I suspect, looking forward to the next few years, it will begin in the investment space. There's a lot of success. People like Richard Curtis's "Make My Money Matter" campaign is getting people to think about, what can they do themselves. Increasingly, they will be, logging into their pension and saying, are there green alternatives that I can invest in, so that I know that my money is doing good stuff for the planet as well as good stuff for me.
Very good.
On that one is that I think there are regulated advisors that can do it. They're automated. It should be regulated advice. It should help people. The workplace service that we deliver is free to all employees who work for that employer who put it in, and therefore they're getting free advice. And it's delivered by a bot, yes, but it was a really simple set of questions because it's to do with my workplace pension scheme. So in simple cases like that, I think it's just a different type of advice, but it can be the same reassuring.
Really good. I'm going to ask one more question because we're nearly out of time. Simon Bussey asks, he says, first of all, thanks, Pete. Then he asks, would like to get your view in the marketplace. We've seen a number of propositions disappear and the banks yet to make a breakthrough. Why? And for those that survive, what do they need to do? And I guess going back to my little intro, if we were kind of sat down in 3 years' time, what do you think we might be surprised by looking back?
So thank you, Simon. I think you know the answer to that question as well. To me, there are breakthroughs happening that we don't see in the open world because people are doing it in the background, needing to evolve. These evolutions are happening. There is success. When I look at the general failure, it's the balance between the new starters who don't have any customers, need volume, and they're trying to build a thing and it's failing because they can't, build it and they will come does not work for a cheap proposition on low amounts of funds. So they struggle. The incumbents who've got the customers and got the money and got the assets can move mountains to change systems and move governance. So it's slow to happen, but it is absolutely happening, and it's generally happening in the background. And when you analyze the cases of spending 30 million quid to put a process together that then failed, you learn, and the next one out of the door doesn't make those mistakes. So I believe in 3 years time, you'll be surprised how many big names are running automated processes, and they didn't make a noise about it, and they ran it for a couple of years before I told you about it because it's a sensible way not to get caught out.
Interesting. That's perfect timing. Pete, Adrian, thank you very much on behalf of everybody who's attended. We look forward to seeing you at the next session, which is on ESG. All the best, everybody. Keep safe.
Thanks for coming, everyone.